Good evening, everybody. Is everybody there? Can you hear me? Okay. It's fantastic to see you. We've got a fantastic evening ahead of us. What we're going to do is we're going to continue where we left off. If you remember, we were strangely part way through a question, this monster investment appraisal question. And what I want to do is I want to complete the question, but I suppose before we do that, what we're going to have to do is to review what is going on. So can I direct you to your notes first of all, page 29. You have this question in front of you. And what I want to do is to remind you of what we were trying to do. So if you dig out your notes, this is how far we had got. If you remember, I said to you that when we look at these classic investment appraisal questions, there's the big five. The big five that we've got to aim for. Firstly, we've got to identify our net trading revenue or operating cash flow. And we've done that. We've got the numbers here. Secondly, tax payable off the back of that, because we identify that there is a cash outflow arising with tax paid on the additional profit earned. Thirdly, scrap, if it exists, often doesn't exist in exam questions. 4, tax relief. And that's where we were when we finished last time. We had just calculated tax relief. 5 of the big 5, something that we'll be looking at in a moment, is working capital. What I'd like to do, if I may, is to simply take you back to the question, so we're absolutely conversant with what it is that we're trying to do. So reviewing the question for you, we said first of all that we had an initial investment. I'm sure we'll incorporate that. At the same stage, we had a sunk cost which we could ignore of 30,000. Straightforward, relevant cost. Then we had the information here, the volumes and the prices, and this all went to establish our operating cash flows. So we inflated up the cash flows, multiplied by the volumes, job done. Of course, we have the residual value, which we've already used. We've got the working capital here. Now I'll highlight that separately, but that working capital is going to be dealt with in a moment. And we were just looking last time, if you remember, about the writing down allowance tax relief. Of course, at some point in the dim distant future when we've done all that, we will then do the discounting, deal with time value of money. But what we'll see is that that is just a tiny part at the end of the question. Okay? So, back to the plot. We'd prepared these values, no problem. But the last working I'd given you was this tax relief working. So I hope you remember how we went about it. We calculated the allowances first of all, and then the reliefs based on those allowances. And of course, it's these reliefs that we're looking at, which we then put back into the main pro forma. Before we leave this, there is a quick and dirty way of doing the same thing. So what I would like to do is to just take you through that quick and dirty way. I don't mind what technique you use, but some of you may like to do things a little bit more quickly. So what I want to do here is to simply look at what the tax relief is and the timing. And remember, because the examiner does it, we assume that the first tax year is year 1. Do you remember that silly point that we discussed last time? So, if we were looking at the tax relief, we could say something like this. The investment was 515,000. Look back at page 29. We know that the writing down allowance in the first year is 25% of that. And we know that tax relief is taken on the writing down allowance at 30%. So we end up with 39. So we get straight to the number that we need. The further thing that we know is this. The nature of writing down allowance is this. If the allowance is 25%, the balance drops to 75% of its former value. So all we have to do to get the value for year 2 and year 3 is to take 75% of the former value. And if we do that, we end up with 29 and 22. Easy peasy, very quick. Of course, in year 4, we need some sort of balancing allowance issue to be dealt with, but we find the year 4 figure in a slightly roundabout way. What we say is this: if we look at our total capital allowances, couldn't we say that the asset was valued at 515? The asset will be valued at 70 at the end of the project. So we know in total terms that the overall asset is going to depreciate by 445 in terms of value. We know that tax relief will be taken at 30% of that, and therefore we can calculate the total figure. And based on that total figure, all we'd establish is what the balancing figure will be. So 30% of 445 shouldn't be too difficult for people of your caliber. Can anyone help me here? I'm coming to 133, but that's in my head. And if it's 133, I'm suggesting that that's 40. My brain's hurting, 43. So maybe, should this be 134, something like that? Okay. Yes, of course, 134. It's just how we round it, isn't it? 44, something like that. Okay. You see? Yeah, you're exactly the same. Thank you so much, Kelsey and Sir. Okay. So, do you like that technique? Well, the fact is, I don't care which technique you use. This technique has the advantage of brevity. It's that much more quick. Whereas this technique, it's maybe easier to understand what you're doing step by step by step. Okay? So I will leave it up to you. So we've got our tax relief. We've done the big 4 of the big 5. We've got our operating cash flow, our tax payable, our scrap, and our tax relief. What we now want to do is we want to look at working capital. So, why is working capital important in the context of this question? Well, the issue is this. If you make an investment, you don't simply invest in the capital asset. You also have to invest in working capital to allow yourself to operate that capital asset. You may need inventory or stock. You may need a receivables balance. And this means that you have to invest cash into the working capital in order to allow that to happen. Now, if we're looking at working capital, all I want to look at is some simple observations. So here's our example first of all. We have a 2-year project, keep it nice and simple, and the working capital need is 40,000. Okay, so we're not going to look at anything sophisticated. Just keep it absolutely simple to begin with. So if we were looking at the years, of course, we start in year 0, that's today, and then we have year 1 and year 2. And all I want to show you, well, is 2 things really. First of all, the technique. It's very simple, but we always start by establishing the balance for working capital. And once we've got the balance, we can easily identify the cash flow. The second thing I wanted to highlight was this. If we need working capital, we will need it today. So we'll need a balance to be 40,000. In year 1, we're not told it changes, so presumably we assume it remains the same. In fact, I wouldn't bother doing this working with something so simple. But the question is, what happens at the end of the project? When the project ceases, do we need working capital? What do you think?